Appreciate you checking out another video from NetPicks. And today we're going to talk about the 21 RSI moving average strategy. Before I get into that, just there's a link down below that you can download a free PDF on trading price patterns. It's actually pretty good piece that I put together for you. So let's get started with this strategy. And quite simply, it's a pretty simple approach to trading. It doesn't require a whole lot of subjective trading analysis, which is pretty important for a lot of traders. If you're a newer trader looking for a place to start, or you're experienced and you have a little bit too many variables going on for a trade, I think you should find this a good starting point for simplicity. So the RSI, we're going to use that to give an objective trend direction. And the RSI is going to be designed to show us just the balance of buyers and sellers. And for this, we're going to use the following indicator settings. We're going to use a 5-period EMA, a 12-period EMA, a 21-period RSI. And again, with all indicators, you're welcome to adjust the settings to suit your style of trading. There's no hard and fast rules, just the longer periods with the averages, for example, it's not going to be as volatile. A 20 EMA and a 50 EMA is not going to give you as many trend change directions. RSI, a lower setting like a 10, it's going to give you a lot more crosses of the 50 line, and we're going to be using that in our trading strategy here, the 50 line. The most important part of any trading strategy is your risk management and your exits, and we'll get to that. So whatever charting package you're using, just find the indicator tab, select the EMA, which is the exponential moving average. Set the periods to 12 and 5. Next up, put the relative strength index on your chart. Use a setting of 21 for the length. That just means we're going to look back 21 periods. And just make sure that the 50 level on the RSI is on the chart. And once completed, it should look something like this. One thing that should stand out is there's minimal clutter, which for traders who like to add price action with any strategy, it's something that's pretty important that you can see price. Let's cover a buy setup. It's pretty simple. We look for the 5-period EMA to cross over top of the 12 EMA, gives us our uptrend. We're going to look for the 21-period RSI to cross the 50 line to the upside, indicating the bulls are in charge. Okay, whatever candle causes that moving average cross or causes the RSI to cross 50, we're going to place a buy stop order above the high. However, if more than 3 candles elapse after either the EMA cross or the RSI crosses, but not both, we're going to skip that pending setup, okay? Because it could be looking at some chop. And this is what that chart looks like. Now, we want to get into a trade when the EMA cross and the RSI crosses 50. Now, there's going to be times, again, where one's going to happen and the other one will take a little too long to get there. We just talked about, and I call it the rule of 3. So if it takes more than 3 candles for the indicators to be both showing a buy, we're going to pass. Because across the averages, that's to get us into what is hopefully a sustained trend. The RSI, when it crosses 50, gets us into the trade because momentum on the bull side is in our favor. So the failure of the lining up of these indicators within 3 periods, the rule of 3, it's a sign that maybe the bulls are not as strong as we'd like. If we've got a selling setup, the exact opposite. The 5-period EMA crosses under the 12 EMA. The 21-period RSI crosses the 50 line to the downside. Whatever candle, again, causes the average cross or the RSI to cross 50. To the downside, we're going to place a sell stop order below the low. And if more than 3 candles elapse after we get the EMA or the RSI cross, we're going to skip the pending setup. And this is what it's going to look like on a chart of Bitcoin. Pretty simple. Where does our stop loss go? There's a bunch of different ways to set your stop using this type of strategy. You could just place your stop under the low for a buy or over the high for a short trade. My favorite method is using the average true range. Now, this daily stock chart, both the EMAs and the RSI are in our favor at that $27.72 marker. It just takes 2 days for price to break that level. Using the entry candle as a stop loss location, your stop would go at $25.60. If we use the 14-period ATR amount, we subtract that from the entry price, your stop will go at $25.44. On this chart here, it makes really no difference. Both stops were never challenged. It would just make a difference in terms of your position sizing. And I like the ATR because it takes into account volatility. And that's my choice for a proper stop location. We got to take our profits somewhere. And I actually cover stops first because protecting your capital, job number one for any trader. And just like stops, there's different ways to take your profits. But what matters is that you're comfortable with it and you can execute it consistently. Now, some traders will just use a multiple of their risks. So if we're using this example, if we use the ATR stop as our stop loss, we have the entry of 27.72. The original stop is 25.44. Means we're risking $2.28 per share. So we just go 1 times your risk. You just exit at $30 because it's just the entry price plus your risk. 2 times your risk, you're going to exit at $32.28. I think you get the picture there. It's pretty straightforward. Now, since we're looking for a trend move, you could also consider using the 12 EMA and the ATR together for a trailing stop. Same stock chart, and as price continues to move up, we're going to adjust our stop using the following calculation. The moving average price minus the ATR equals our new stop price. So the black arrows are where the calculation was done for those 2 new price points. Just for the record, this chart actually stopped out at $41.09. So this was a $13.37 gain per share. What about sideways markets? You know, whenever we use moving averages, whipsaw is a reality. The moving averages just snake around each other. So in a trading range, while you will see the moving averages snake, you could also get the RSI popping up and below the 50 level. So let's keep in mind trending structure. So an uptrend makes higher highs and higher lows. A downtrend starts to make lower highs and lower lows. A trading range is a mixture of the two. So my general rule for an uptrend, as soon as price fails to make a higher high, right, but it does make a higher low, I consider that a trading range could be coming. The next low, which could also be a higher low, puts me on red alert, and the next high is going to make the difference. It has to be a higher high for me to ignore that a trading range is forming. So are you going to miss some trades? Yeah, you will. Well, maybe. If we consider price location, maybe not. So if price is in a potential trading range and it's at the upper zone of the range, consider only taking trades to the downside. And if price at the bottom of the range, consider only long trades. The reason for this is that ranges will eventually break. So if you use that strategy, you'd already be in a live trade before the breakout. And when breakouts happen, they often do with momentum. So you could find yourself in some pretty deep profits pretty quickly using that strategy. Now, these types of strategies are pretty easily built upon, as we just talked about with trading ranges. They're not rocket science, and really they can be applied by those looking to day trade, or we can only check their charts once per day for a swing trade. And I think using the trend following trailing stop loss, to me, that's the best way to do this. Get some healthy profits over the long term, trade the trend until it ends kind of thing. Any questions or comments, pop them below. Just make sure you guys grab that free PDF, and we'll catch you in the next video.